Welcome back, everyone. Ready to dive into another fascinating topic.
Always. What are we looking at today?
Today, we're going deep on stock buybacks.
Interesting.
And specifically, we're going to look at how they impact executive compensation.
Okay, so how those big buyback programs can lead to even bigger bonuses for CEOs and other execs.
You got it.
Makes sense. Fewer shares usually means higher earnings per share. And a lot of these execs have compensation packages tied to hitting those EPS targets.
Exactly. And that's what we're going to unpack today using a 2015 special report from Reuters as our guide.
What was the title again?
It was called Stock Buybacks Enrich the Bosses Even When Business Sags.
Yeah, that pretty much sums it up, doesn't it?
Yeah.
Sounds like it could be a juicy one.
It is. It really digs into how some companies might be using buybacks to kind of game the system.
Game the system how?
Well, by inflating earnings per share, they can hit those bonus targets, even if the company isn't actually doing that well overall.
Ah, I see. So it's like prioritizing short-term gains and executive bonuses over, the long-term health of the company.
Right.
Okay, I'm definitely interested to hear more about this. Where should we start?
Well, first, maybe let's just break down the mechanics of a stock buyback. Like, how does it actually work?
Sure. So basically, a company uses its own cash to repurchase its shares from the open market. And when they do that, it reduces the number of outstanding shares,
Okay.
which can make the earnings per share look better, even if the company's profits haven't really changed.
So fewer shares means those earnings are divided among a smaller pool, so each share appears more valuable.
Exactly.
But why is everyone so obsessed with earnings per share, or EPS?
Well, a lot of companies tie executive bonuses to hitting certain EPS targets.
Okay.
So even if that EPS boost comes from buybacks, not actual, operational improvements, those execs can still get those big bonuses.
That's where things get a little, well, tricky. The report gives us a few examples of companies where buybacks seem to have played a pretty big role in boosting executive compensation.
Oh, really? Like who?
Well, they start with Humana, the health insurance company.
Right.
So back in 2014, they had a 21% drop in net income.
Ouch. That's not good.
But they announced a $500 million stock buyback program, which helped them boost their EPS, get past their target, and trigger a bonus for their CEO, Bruce Broussard.
Ah, so even though their net income was down, they still hit their EPS target thanks to the buyback.
Exactly.
Interesting.
And it almost seems like they were, trying to hit that target no matter what.
Like it was all part of the plan.
Yeah, maybe. The report even mentions that Humana's board had previously adjusted their EPS calculations.
To make it easier to hit those targets.
Right. It definitely benefited their executives.
I see. And they used, wasn't it called an accelerated share repurchase to make those buybacks happen faster too?
Yes, to get that immediate impact on EPS.
So they were really front-loading those buybacks to hit that EPS number. Wow.
Yeah. And Humana isn't the only one.
Oh.
There are a few other companies mentioned, including Xerox.
What happened at Xerox?
In 2014, they actually met their EPS target,
Okay.
even though they had declines in revenue, net income, and even spending on research and development.
So how'd they pull that off?
You guessed it, stock buybacks played a major role.
I knew it.
Their CEO, Ursula Burns, ended up receiving a big bonus, all thanks to hitting that EPS target.
So even when the company's overall financial health isn't great, buybacks can create this illusion of success, at least when you're just looking at EPS.
Right. And that's a big concern. It can give investors who are relying on metrics like EPS a distorted picture of how the company's really doing.
Yeah, that makes sense. So any other companies we should know about?
The report also touches on Activision Blizzard and Amgen.
Oh, those are big names. Okay, so Activision Blizzard, the video game company.
Right, the folks behind Call of Duty and all that.
Okay, what did they do?
They used buybacks to boost their share price, which ended up benefiting their CEO, Robert Kotick, even though their net income actually dropped.
And what about Amgen?
They had a huge buyback program back in 2011, and it led to a big bonus for their CEO, even though their net income was lower compared to previous years.
Wow.
What's interesting is that Amgen actually ended up removing EPS as a performance metric altogether.
Oh, wow, really?
Yeah. It's like they realized that using EPS was encouraging buybacks, even when it wasn't really in the company's best interests over the long term.
Makes you think, doesn't it? It's like this whole focus on buybacks to pump up share prices might be discouraging companies from investing in stuff that's really important for long-term growth.
Right, like research and development, capital expenditures, even things like employee compensation could suffer.
Yeah, you're trading short-term gains for shareholders and execs for the long-term health and potential of the company.
And then there's the issue of income inequality.
Oh, right. That's a big one.
If executive pay is tied to metrics that can be manipulated by these buybacks, it can really widen the gap between the highest earners and everyone else.
It creates this system where executives get rewarded even when the company's performance isn't that great, all because of financial maneuvering. Makes you wonder if all companies are doing this, though. Are there any companies out there doing things differently?
Luckily, yes. There are some companies that have recognized the issues with tying executive compensation so closely to EPS.
Okay, that's good to hear. So what are they doing instead?
Well, some companies like Johnson & Johnson, FedEx, Time Warner, and even IBM have adjusted how they calculate EPS. They've specifically excluded the impact of buybacks when determining executive pay.
So they're basically saying we want to reward our executives for actual improvements in the business, not just financial tricks.
Exactly. They want to encourage real growth, not just manipulating EPS through buybacks.
Makes sense. Are there any companies taking this even further?
There are. Some have completely ditched EPS as a performance metric altogether.
Wow, that's a bold move. Who's doing that?
A couple mentioned in the report are Citrix Systems and DaVita.
Interesting. What are they using instead?
They've moved to metrics that focus on things like revenue growth, profitability, customer satisfaction, and innovation.
So they're trying to reward executives for creating real value, not just playing the stock market.
Yep. And it's refreshing to see some companies challenging the status quo, looking for more responsible ways to measure performance and reward their executives.
Yeah, definitely. This all raises a pretty important question, though.
What's that?
How should we, as investors, be evaluating company performance and executive compensation in this world where stock buybacks are so common?
It's a good question. I think we need to look beyond those headlines about buybacks and EPS growth. Really dig deeper.
Definitely. We need to be asking those tough questions. What are the company's real drivers of growth? Are they investing in their future? Is executive pay tied to real value creation?
Absolutely. It's about understanding the company's strategy and how they're using their resources.
We can't just accept buybacks as the norm. We need to be informed investors, holding companies accountable for their decisions.
I agree. This deep dive has been really eye-opening for me. Stock buybacks are way more complex than they seem at first glance.
It's about understanding the motivations behind them, what the consequences could be, and what other options companies have.
And realizing that there's more to a company's success than just its stock price.